There exists a force in the financial universe so powerful, so pervasive, that it governs the rise and fall of fortunes, the birth and death of companies, and the very mood of the global economy. It is not sentiment, it is not news, it is not even corporate earnings. It is a silent, invisible tether that pulls on the value of every single asset on Earth. It is the financial equivalent of gravity. And for the vast majority of his career, Warren Buffett has understood that mastering the markets, achieving true financial freedom, and building generational wealth depends almost entirely on understanding this one single concept. He has stated, in no uncertain terms, that interest rates are to asset prices what gravity is to the apple. And just as an apple must eventually fall, all asset prices must eventually bow to the immutable law of financial gravity. Most investors spend their entire lives fixated on the apple. They study its color, its shape, its growth trajectory. They debate whether it's a Granny Smith or a Red Delicious. They build complex models to predict precisely when it will be perfectly ripe. But they never once look down. They never once consider the force pulling on it, the force that will ultimately determine its fate. They operate in a world where they believe the apple can fly. And so, they are perpetually, catastrophically surprised when it comes crashing to the ground. This fundamental misunderstanding, this ignorance of the financial environment, is the single greatest destroyer of wealth for the retail investor. It is the hidden tripwire that sends portfolios plummeting, even when every company within that portfolio seems to be performing perfectly. What we are about to embark on is not a simple stock tip or a fleeting market trick. It is a foundational lesson in financial education, a journey into the very physics of value. We will deconstruct Buffett's most powerful mental model, piece by piece, until it becomes an intuitive part of your own decision-making process. This is the key to transforming from a reactive gambler shocked by the market's whims into a proactive strategist who sees the tidal shifts before they happen. We will explore the law of financial gravity itself, understanding its mechanics. We will see how this force exerts a different pull on different types of investments, explaining why your high-flying growth stocks can get crushed, while stodgy, old-fashioned companies barely flinch. We will journey to the very center of this gravitational field, to the institution that controls its intensity, the Federal Reserve. We will then translate this theory into a practical portfolio strategy, a blueprint for building an ark before the rain begins, a method for ensuring capital preservation in any economic weather. And finally, we will elevate this concept from the investor to the operator, adopting the CEO mindset to see how the masters of capital allocation use their understanding of financial gravity to build unshakable empires. This is the knowledge that separates the amateur from the professional, the 99% from the 1%. This is the final promise of financial literacy, to no longer be a victim of the market cycles, but to become a master of them. Our first step is to journey back in time, to an era of irrational exuberance, a time when the world believed that the laws of financial physics had been permanently repealed. It was the twilight of the 20th century, and a new paradigm was taking hold. The internet was a toddler, taking its first explosive steps, and with it came a mania the likes of which the world had not seen in generations. It was the dot-com bubble, and for a brief shining moment, it seemed that gravity had been turned off. In late 1999, Fortune magazine published an article that would become one of the most famous, and at the time most ridiculed, pieces of financial commentary ever written. The author was Warren Buffett, and the title was simply Mr. Buffett on the Stock Market. While the rest of the world was enchanted by a new breed of companies with no profits, no tangible assets, and often no coherent business plan, Buffett played the role of Isaac Newton, sitting under the apple tree, quietly explaining that what goes up must in fact come down. The market was a frenzy of initial public offerings. Companies like Pets.com, Webvan, and TheGlobe.com were soaring to billion-dollar valuations overnight. The narrative was intoxicating. The internet had changed everything. Old metrics like price-to-earnings ratios were relics of a bygone era. The new metric was eyeballs, clicks, user growth. It was a classic speculative bubble, fueled by a powerful story and crucially by a low-gravity environment. Throughout the late 1990s, interest rates were relatively low and stable. The 10-year Treasury bond, the benchmark for the risk-free rate of return in the United States, hovered in a comfortable range. This meant that the gravitational pull on asset prices was weak. In this environment, investors are willing to pay a premium for future growth, because the alternative, parking your money in a safe government bond, offers such a paltry return. This is the physics of the situation. A bond yielding 6% is a formidable competitor for stocks. A bond yielding 4% is less so. The lower the rate, the less gravity is pulling on stock valuations, allowing them to float higher and higher into the stratosphere. In his Fortune article, Buffett laid out the analogy with chilling precision. He explained that all investments are valued by looking at their future stream of cash flows and then discounting those cash flows back to the present day. The discount rate you use is the critical variable, and it is anchored by the prevailing interest rate. He wrote, and it's worth quoting, "The value of every business, the value of a farm, the value of an apartment house, the value of any economic asset is 100% sensitive to interest rates. A ridiculously low interest rate can cause a stock market bubble." He saw a market completely detached from this reality. He saw analysts projecting corporate profit growth that was mathematically impossible to sustain. He saw a public that had forgotten 2 world wars and a Great Depression and believed that stock market returns of 20% per year were a birthright. The S&P 500 had compounded at nearly that rate for almost 2 decades. But this performance was supercharged by a massive tailwind. Interest rates had fallen from the high teens in the early 1980s to the mid-single digits. Gravity had been steadily weakening for 17 years, pushing asset prices relentlessly upward. Investors mistook this one-time environmental shift for a permanent new state of being. Buffett's warning was simple. That tailwind was not going to last forever. And worse, people were now extrapolating that past performance into the future, at a time when valuations were already at nosebleed levels. He pointed to the total market capitalization of all U.S. stocks as a percentage of the country's gross national product, GNP. This metric, which later became known as the Buffett indicator, was screaming red. For most of the 20th century, it had fluctuated in a reasonable range. But in 1999, it was hitting all-time highs, indicating that the value of stocks had become completely unmoored from the value of the underlying economy that was supposed to support them. He was essentially showing a photograph of a man who had jumped from a 50-story building and, as he passed the 20th floor, was heard to be saying, "So far, so good." The reaction to Buffett's article was largely dismissive. He was called a dinosaur, a man who didn't get the new economy. He was criticized for sitting on a mountain of cash at Berkshire Hathaway, failing to participate in the greatest wealth creation engine of all time. But Buffett wasn't making a prediction about technology. He was making an observation about financial physics. He knew that even the most revolutionary technology company is still subject to the law of financial gravity. A few short months later, in March of 2000, the bubble burst. The Nasdaq index, the epicenter of the dot-com mania, began a brutal collapse that would wipe out nearly 80% of its value over the next 2.5 years. Companies that were once worth billions evaporated into nothing. The apples came crashing down. And Warren Buffett, who had been mocked for his caution, was revealed not as a dinosaur but as the only physicist in a room full of alchemists. He hadn't predicted the future, he had simply understood the present and the immutable force that governs it. The psychological trap that ensnared millions of investors during the dot-com bubble is one of the most powerful and insidious in all of behavioral finance. It's a toxic cocktail of several cognitive biases, but at its core is a flaw in how we perceive patterns and project the future: recency bias. This is our brain's tendency to give greater importance to recent events than to historical ones. For an investor in 1999, the recent past was an almost uninterrupted 17-year bull market. Their entire lived experience as an investor was one of stocks going up. The memory of the stagnant, inflationary 1970s, a period of high financial gravity, had faded into irrelevance. Their brains, by default, took the recent trend and extrapolated it forward indefinitely. They believed that the low-gravity environment of the 1990s was the new normal, a permanent state of affairs. This bias was supercharged by another powerful force, confirmation bias. As tech stocks soared, a powerful narrative formed around the new economy. This story, propagated by media outlets, Wall Street analysts, and chat rooms, insisted that traditional valuation metrics were obsolete. Investors, already primed by recency bias to believe the good times would last, actively sought out information that confirmed this narrative. They read the bullish analyst reports, they listened to the pundits proclaiming a new golden age, and they ignored the lonely voices of caution like Warren Buffett. To accept Buffett's premise that interest rates still mattered would have been to challenge their entire worldview and admit that the easy money they were making was not a result of their own genius, but of a temporary environmental condition. It's far more comforting to believe you're a genius than to believe you're simply lucky. This creates a dangerous feedback loop. As prices rise, the narrative gets stronger. As the narrative gets stronger, more people buy in, pushing prices even higher. This is the anatomy of a bubble. The participants are not irrational in the sense of being crazy. They're responding rationally to the incentives and information within their bubble. The irrationality lies in their failure to consider the one external factor that could pop the bubble, a change in the gravitational field. They anchored their expectations to a single data point, the current low level of interest rates, and failed to appreciate that this was a variable, not a constant. They saw the world in two dimensions, ignoring the third dimension of the economic environment that underpins everything. Buffett's genius was not in having a crystal ball, but in his disciplined ability to overcome these innate psychological biases. He zoomed out, looked at the long arc of financial history, and saw the present moment for what it was, an anomaly, not a new paradigm. He understood that human psychology is cyclical, and that the euphoria that leads people to believe gravity has been repealed is the surest sign that its pull is about to be felt with devastating force. So how do we, as retail investors and entrepreneurs, translate this high-level understanding into a practical tool? How do we build a mental model that allows us to see financial gravity at work in our own decisions? The answer lies in mastering a simplified version of the very calculation Buffett referenced, the discounted cash flow, or DCF model. This sounds intimidating, but the concept is remarkably simple. It's the blueprint for valuing any asset, and it directly incorporates financial gravity. Let's call it the DCF gravity check. Step 1 of the blueprint: project the future cash flows. Imagine you're looking at a business, let's call it Staples Inc. It's a solid, predictable company that generates $100 in cash flow for its owners each year. For simplicity's sake, let's assume this cash flow will stay at $100 forever. Your task as an investor is to determine what you should pay today for that future stream of $100 bills. Step 2. Choose your discount rate. This is where gravity enters the equation. The discount rate is the rate of return you demand to compensate you for the risk and the time value of money. The foundation of this discount rate is the risk-free rate, what you could earn by taking zero risk, typically represented by the yield on a long-term U.S. Treasury bond. Let's say we live in a low-gravity world, just like the late 1990s. The 10-year Treasury bond yields a mere 2%. You might decide that for investing in Staples Inc., which carries some business risk, you demand a premium of 4% over the risk-free rate. So your total discount rate is 2% plus 4%, which equals 6%. Step 3. Apply the gravity. The formula to find the present value of a perpetual stream of cash is simple. You divide the annual cash flow by the discount rate. So you take the $100 in cash flow and divide it by your 6% or 0.06 discount rate. The result is $1,667. In this low-gravity environment, Staples Inc. is worth $1,667. Now let's watch what happens when the master of the tides, the Federal Reserve, decides to increase the force of financial gravity to fight inflation. They raise interest rates, and the 10-year Treasury bond yield shoots up from 2% to 6%. This is a monumental shift in the financial environment. You still demand that same 4% premium for taking the risk of owning the stock, but now your starting point, the risk-free rate, is much higher. Your new discount rate is the 6% risk-free rate plus your 4% equity premium, which equals 10%. Let's rerun our calculation. The business has not changed one bit. Staples Inc. is still projected to generate the exact same $100 in cash flow every year. It's the same company, with the same products and the same management. But the external environment has changed. We now divide that $100 in cash flow by our new, higher discount rate of 10%, or 0.10. The result is $1,000. Pause and consider what just happened. The intrinsic value of the business collapsed from $1,667 to $1,000, a drop of 40%, without anything about the business itself changing. The only thing that changed was the force of financial gravity. This is the hidden force that secretly controls stock prices. When you buy a stock, you are not just buying a piece of a business. You are making a bet on its future cash flows, and the value of those future cash flows is inexorably tied to the prevailing level of interest rates. The DCF gravity check is your personal instrument for measuring this force. Before making any investment, run this simple thought experiment. Ask yourself, what is the implied discount rate in the current stock price? What would happen to my valuation if the risk-free rate were to double? This simple, two-step mental model forces you to acknowledge the gravitational field you're operating in, protecting you from the folly of believing your apples can fly. To truly appreciate the wisdom of Buffett's approach, we must dedicate some time to exploring its antithesis, the path of the 99%. This is the road most traveled, and it is littered with the wreckage of portfolios and broken dreams. The quintessential resident of this path during the dot-com bubble was the day trader, the momentum chaser, the retail investor who believed that the internet had fundamentally broken the old rules of finance. Their world was not one of cash flows and discount rates. It was a world of narratives, ticker symbols, and the intoxicating thrill of watching a stock double in a week. They weren't investing in businesses. They were betting on memes. Take a company like Pets.com. The story was compelling. They would be the Amazon of pet supplies. They had a catchy name and a popular sock puppet mascot that even appeared in the Super Bowl. For the 99%, this was enough. The stock IPO'd and soared. They didn't ask about profit margins, customer acquisition costs, or a path to profitability. They certainly didn't perform a DCF gravity check. Why would they? The stock was going up. Their neighbors were getting rich. The media was celebrating this new Gilded Age. Their decision-making framework was based entirely on social proof and momentum. It must be a good company because the stock price is rising. This is the intellectual equivalent of determining the direction of a river by looking only at the bobbing cork on its surface, without any awareness of the underlying current. They were focused on the price, not the value. They were playing a game of musical chairs, convinced they'd be able to find a seat before the music stopped. The catastrophic flaw in this approach is that it is entirely dependent on a low-gravity environment. The only reason someone would pay a ludicrous price for a money-losing company like Pets.com is the belief that someone else, a greater fool, will pay an even more ludicrous price for it tomorrow. This chain only holds together when money is cheap, and alternative investments, like bonds, are unattractive. It is a system with no anchor to reality, a helium balloon with a fraying string. When the Federal Reserve, under Alan Greenspan at the time, began to tap the brakes and raise interest rates in 2000, it was the equivalent of taking a pair of scissors to that string. The music didn't just stop. The entire orchestra pit collapsed into a sinkhole. As gravity reasserted itself, the entire foundation of the greater fool theory disintegrated. Suddenly, investors started asking the questions they should have been asking all along. How much cash does this company actually generate? What are its assets? The answer, in most cases, was zero and none. Pets.com, which at its peak had a market capitalization in the hundreds of millions, went from IPO to liquidation in just 268 days. Its story is not an outlier. It is the poster child for the path of the 99%. Their failure was not a matter of bad luck. It was preordained by their willful ignorance of financial physics. They built their houses on a foundation of sand, and when the tide of interest rates turned, they were washed away. This is the brutal, predictable consequence of ignoring the single most important force in finance. The connection between this abstract principle of financial gravity and your personal wealth is not theoretical. It is direct, quantifiable, and it manifests in the numbers that define your financial life. Let's start with your investment portfolio. The most common valuation metric you'll hear about is the price-to-earnings, or PE, ratio. This is simply the price of a stock divided by its annual earnings per share. It's a shorthand for how much the market is willing to pay for $1 of a company's current profits. Financial gravity, as set by interest rates, is the primary determinant of the market's overall PE ratio. Think of the PE ratio as the inverse of an earnings yield. A stock with a PE of 20 has an earnings yield of 5%, 1 divided by 20. This earnings yield is in constant competition with the yield on a risk-free U.S. Treasury bond. If the 10-year Treasury is yielding only 1%, an earnings yield of 5% from a solid company looks incredibly attractive. Investors will bid up the price of that stock, causing its PE ratio to expand to 25, 30, or even higher. The market is justifying this by saying, why would I accept a guaranteed 1% from the government when I can get a potential 5% from this business? This is a low-gravity environment in action. Now imagine the Federal Reserve raises rates and the 10-year Treasury yield climbs to 5%. Suddenly, the 5% earnings yield from our stock doesn't look so special. It's the same as the risk-free rate. Why take on the risk of owning a business? The risk of competition, mismanagement, and economic downturns to get a return you can now get with zero risk from the U.S. government. Investors will sell the stock, and its price will fall until its PE ratio compresses. Perhaps it falls to a PE of 12.5, which represents an earnings yield of 8%, 1 divided by 12.5. Now that 8% yield offers a compelling 3% premium over the risk-free rate, and investors are once again interested. Notice, the company's earnings never changed in this scenario. The business did nothing wrong. The only thing that changed was the gravitational field, and it directly caused a massive compression in the valuation multiple, wiping out a significant portion of the stock's value. This is how a change in interest rates translates into a tangible loss or gain in your brokerage account. This force also snakes its way onto the balance sheets of the companies you own. Most businesses use debt to finance their operations and growth. The interest rate on this debt is directly tied to the benchmark rate set by the Fed. When financial gravity is low, a company can borrow money at 3%, invest it in a project that returns 10%, and create immense value for shareholders. But when gravity increases and the cost of new debt rises to 8%, that same 10% project now looks far less attractive. Worse, if the company has existing variable rate debt, its interest expenses on the income statement will skyrocket, directly reducing its net income and earnings per share. A healthy business can become a struggling one simply because the cost of its financing has changed. Understanding financial gravity allows you to analyze a company's debt structure and see it not as a static number, but as a potential vulnerability to a changing economic environment. It provides a deeper layer of stock market analysis, moving you beyond simple metrics and into the realm of strategic, forward-looking assessment. This is the first step toward true wealth management, understanding not just your assets, but the invisible forces acting upon them. Now that we have established the fundamental law of financial gravity, we must examine its nuances. For just as gravity on Earth pulls on a feather and a cannonball with the same force but with dramatically different effects, financial gravity does not affect all assets equally. Its pull is felt most acutely by a specific category of investments, the very same category that tends to capture the public's imagination and dominate headlines: high-growth stocks. Understanding this distinction, the difference between what are called long-duration and short-duration assets, is the key to navigating the violent rotations that can rip through a market when the gravitational environment shifts. Our foundational anecdote for this principle doesn't involve a single transaction, but rather a tale of two starkly different investment philosophies, embodied by two very different entities: Warren Buffett's Berkshire Hathaway and, more recently, Cathie Wood's ARK Innovation ETF. This contrast perfectly illustrates the physics of duration. Consider one of Buffett's most celebrated investments, See's Candies. He purchased the company in 1972 for $25 million. See's is the quintessential short-duration asset. Its value is not based on a distant speculative promise. It is based on the cash it generates right here, right now. It sells chocolates, and people buy them, generating predictable, stable profits year after year. The bulk of its intrinsic value is derived from cash flows that will occur in the next 1, 3, 5 years. They are close to us in time. Now contrast this with the types of companies that populated the ARK Innovation ETF during its meteoric rise in 2020 and 2021. These were revolutionary, disruptive companies in fields like genomics, robotics, and artificial intelligence. Many were unprofitable, and some had very little revenue. Their valuations, which soared to astronomical levels, were not based on current cash flows, because there were none. They were based on the promise of enormous cash flows far, far in the future, 10, 15, even 20 years from now. These are the ultimate, long-duration assets. Their value is almost entirely dependent on that distant, shimmering promise. In 2020 and 2021, the world was in a near-zero gravity environment. The Federal Reserve had cut interest rates to historic lows to combat the economic effects of the pandemic. The 10-year Treasury yield flirted with 0.5%. In this world, the distant future feels incredibly close. When the risk-free alternative gives you virtually nothing, waiting 15 years for a massive payoff seems perfectly reasonable. The discount rate applied to those far-off profits is tiny, making their present value enormous. In this environment, long-duration assets like those in the ARK ETF flourished. See's Candies, with its boring, predictable profits, looked like a relic. Why own a chocolate company when you could own the future of the human genome? The market punished short-duration value and richly rewarded long-duration growth. Then, in 2022, the environment changed. Inflation, which had been dormant for decades, came roaring back to life. The Federal Reserve was forced to embark on one of the most aggressive rate-hiking cycles in its history. Financial gravity was dialed up from 1 to 11 almost overnight. The 10-year Treasury yield surged from under 1% to over 4%. Let's return to our DCF gravity check model. When the discount rate rises, it has a mathematical effect on all future cash flows, but the effect is not linear. A higher discount rate punishes distant cash flows far more severely than it punishes near-term cash flows. The value of See's Candies profits next year might take a small hit, but the value of a speculative biotech company's projected profits in 2038 gets absolutely annihilated. It's like looking at a train through a pair of binoculars. When the train is far away, a small shake of your hand makes the image of the train jump wildly. When the train is right in front of you, the same shake barely matters. Rising interest rates are the shake, and the distance to the profits is the duration. The result was a market cataclysm. The ARK Innovation ETF collapsed, falling nearly 80% from its peak. Many of its holdings fell even further. Meanwhile, Berkshire Hathaway, with its portfolio of stable, cash-gushing, short-duration businesses, weathered the storm magnificently. Buffett's strategy was revealed not as outdated, but as timeless. He had built a portfolio designed to withstand a return to normal gravity. The proponents of disruptive innovation had built a portfolio that could only survive in the zero-gravity vacuum of speculative space. This stark divergence wasn't about See's Candies being a better company than a genomics firm. It was about the fundamental physics of their valuation. One was a cannonball, held firmly to the earth. The other was a feather, tossed violently by the slightest change in the financial winds. The psychological phenomenon that makes long-duration growth stocks so seductive in low-gravity environments is known as hyperbolic discounting. This is a cognitive bias where people tend to choose a smaller, sooner reward over a larger, later reward. We are inherently impatient creatures. If I offer you $100 today, or $110 in a month, most people will take the $100 today, even though the annualized return on waiting is astronomical. We discount the future hyperbolically, meaning we value the immediate present far more than any future date. However, the financial environment can dramatically suppress or amplify this innate bias. When interest rates are near zero, the opportunity cost of waiting feels negligible. The $100 you could have today can't be put in a bank to earn any meaningful interest anyway. So the allure of that larger, later reward, the massive potential profits of a revolutionary tech company in 2035, grows stronger. Our natural impatience is tranquilized by the lack of a viable, immediate alternative. The future starts to feel cheaper and closer. We become more willing to pay exorbitant prices for a story about tomorrow, because today is offering us so little. This psychological shift fueled the frenzy for growth stocks in 2021. When interest rates rise sharply, the effect is reversed with a vengeance. Suddenly, that $100 today can be put into a risk-free government bond earning 5%. The opportunity cost of waiting for that distant, uncertain payoff becomes excruciatingly real. Our latent hyperbolic discounting comes roaring back to the surface. The pain of foregoing a guaranteed 5% return now times for a speculative return in a decade becomes unbearable. This triggers a mass psychological migration. Investors who were once patient visionaries become impatient pragmatists. They dump their long-duration story stocks and flock to the safety and certainty of short-duration assets, companies that are profitable now. This isn't a rational, calculated portfolio adjustment for most people. It's a visceral, emotional reaction. It feels like a stampede, a frantic rush for the exits from the burning theater of speculation. The same investor who confidently explained why their favorite unprofitable tech stock was worth 100 times sales in 2021 is now terrified and selling at 5 times sales in 2022. The underlying business may not have changed much, but the psychological lens through which they view the future has been completely shattered and reformed by the changing force of financial gravity. Understanding hyperbolic discounting allows you to see this rotation not as a random panic, but as a predictable psychological response to a changing environment. It allows you to be the calm observer, understanding the stampede, rather than being a part of it. You can recognize when the market's collective patience is artificially high and when it's about to snap back to its impatient, unforgiving baseline. To protect ourselves from being swept away by these violent psychological tides, we need a practical mental model to manage our portfolio's sensitivity to financial gravity. We need a tool to measure and control our duration exposure. Let's call this the duration stress test, a simple 3-step blueprint for a more resilient portfolio strategy. Step 1. Classify your holdings. Go through your entire investment portfolio, stock by stock, and place each one into one of 2 buckets: short duration or long duration. The definitions are straightforward. A short-duration asset is a company that is currently profitable, has a strong balance sheet, and ideally pays a dividend. Its value is derived from cash flows that are happening now or in the very near future. Think of companies like Coca-Cola, Procter & Gamble, or a stable utility company. A long-duration asset is a company whose value is based almost entirely on the promise of future growth. This includes most unprofitable tech companies, speculative biotech firms, and any business where you are betting on a massive success 10 or more years down the line. Be honest in your assessment. If a company's stock would be worthless without its 10-year growth story, it's a long-duration asset. Step 2. Run the stress test. For each of your long-duration assets, you must ask a series of hard questions. This isn't about precise math, but about developing a feel for their vulnerability. Ask, what is the core assumption that justifies this valuation? Often the answer is a combination of massive revenue growth and an eventual shift to high profitability. Then, the crucial question, what happens to the appeal of this stock if the 10-year Treasury yield goes from 2% to 5%? Remind yourself of the physics. That higher risk-free rate makes the wait for future profits more painful and less valuable. Would the market still be willing to pay 30 times sales for this company? Or would that multiple compress to 10 or even 5? Mentally haircut your own valuation based on a higher gravity scenario. If the result is a 70% or 80% drop, you have identified a highly duration-sensitive asset. Step 3. Set rules for asset allocation based on duration. This is where you translate your analysis into action. The goal is not to eliminate long-duration assets entirely. They are an important source of potential growth. The goal is to manage your total exposure to them based on your assessment of the economic environment. You might set a rule for yourself. I will never let long-duration assets exceed 30% of my total portfolio. Or, you might get more dynamic. When the Federal Reserve is cutting rates and inflation is low, a low-gravity environment, I will allow my long-duration allocation to drift up to 40%. When the Fed is raising rates and inflation is high, a high-gravity environment, I will actively trim that allocation back down to 20%. This framework forces you to think like a strategist. You are no longer just buying individual stocks. You are managing a balanced portfolio whose characteristics are intentionally designed to handle different gravitational seasons. It's a proactive approach to capital preservation that moves you light years beyond the hope-based strategies of the average retail investor. The path of the 99% is, once again, paved with the opposite of this structured thinking. The antithetical approach is that of the all-in on innovation investor, a character who became incredibly common in 2020 and 2021. This investor isn't just optimistic about the future, they are dogmatic about it. They believe that disruptive technology has created a new paradigm that has permanently invalidated old-school valuation principles, like paying attention to interest rates. Their mantra is, "This time is different." This investor's portfolio is not a balanced collection of assets, it is a concentrated bet on a single theme. It consists of 100% long-duration, high-beta growth stocks. They don't see this as risky, they see it as visionary. They mock the cautious, diversified investor as a dinosaur, someone who doesn't get it. They populate online forums, creating an echo chamber where their belief system is constantly reinforced. Any data point that contradicts their worldview, like rising inflation or hawkish signals from the Federal Reserve, is dismissed as noise or a temporary blip. Their confirmation bias is running at full throttle. The emotional journey of this investor is a dramatic one. In the low-gravity environment of 2021, they feel like a certified genius. Their portfolio is up 100%, 200% or more. They are condescending to those who warned of a bubble. They take on leverage, using margin to double down on their favorite high flyers. They believe they have discovered the secret to beating the market, but their success is built on the unstable foundation of a temporary economic condition. They have built a magnificent skyscraper on a frozen lake, mistaking the ice for solid ground. Then, the season changes, the Fed begins to raise interest rates, the financial gravity intensifies, and the ice begins to crack. The first 20% drop in their portfolio is brushed off as a, quote, healthy correction, a great buying opportunity. They may even add more capital. But then the drop accelerates to 40%, then 60%. The narrative of the visionary genius begins to crumble, replaced by the cold, hard reality of margin calls and catastrophic losses. Their mistake was not their belief in technology. Their mistake was their complete and utter disregard for duration and the economic environment. They believed that the quality of their chosen companies made them immune to the macro forces of finance. They focused only on the apple and never considered gravity. The devastating drawdowns they suffer, often 70%, 80% or more, are not just a temporary setback. For many, they are a permanent impairment of capital from which they will never recover. They learn, in the most brutal way possible, that while the story of innovation is exciting, the laws of financial physics are unforgiving. The direct financial connection between interest rates and the value of growth stocks is one of the most dramatic and quantifiable effects in all of finance. It revolves around the valuation multiples the market is willing to pay. For a stable, profitable, short-duration company, the valuation multiple is often the P/E ratio. But for an unprofitable, long-duration growth company, there are no earnings. So the market turns to another metric, the price-to-sales PS ratio. This is the company's total market capitalization, divided by its annual revenue. And this is where the carnage of 2022 was most visible. In the zero-gravity environment of 2021, it was not uncommon to see software or biotech companies trading at PS multiples of 30, 50, or even 100. Let's translate that. A PS ratio of 50 means investors were willing to pay $50 for every $1 of that company's current sales. This is only logically justifiable if you make two enormous assumptions. First, that revenues will grow at an exponential rate for a very long time. And second, that the discount rate applied to the distant future profits from those revenues is infinitesimally small. It is a valuation built entirely on the absence of financial gravity. Now let's watch the math as gravity returns. The Federal Reserve raises rates, and the 10-year Treasury yield goes to 4%. The discount rate that investors use to value those far-off hoped-for profits skyrockets. Suddenly, a PS ratio of 50 is no longer just aggressive. It is certifiably insane. The market reprices the stock for the new, high-gravity reality. That same company might now be seen as fairly valued at a PS ratio of 8. The company itself may have done nothing wrong. It may have even grown its revenues as promised. But the multiple the market is willing to pay has compressed by 84%. A $1 million position in that stock is now worth $160,000. This is not a hypothetical scenario. This exact dynamic played out across the entire universe of growth stocks from late 2021 through 2022. It was a mass extinction event for high multiple stocks. This is why understanding duration is a critical component of risk management and wealth management. A portfolio heavily tilted toward companies trading at extreme PS ratios is not a portfolio. It is a ticking time bomb, its fuse length determined by the whims of the Federal Reserve. By performing a duration stress test on your holdings and being aware of their valuation multiples, you can see these risks before they detonate. You can understand that a stock's price is composed of two things: the underlying performance of the business and the multiple the market is willing to pay. And that multiple is a direct hostage of financial gravity. We have now established the law of financial gravity and seen how it affects different assets. But this naturally leads to a critical question. Who controls this force? Who is at the center of the financial solar system, dialing the intensity of gravity up or down? In the United States, and indeed for much of the global economy, that power resides with a single institution, the Federal Reserve. To truly master the market cycles, an investor must understand the Fed, not as a mystical entity, but as an organization with a specific mandate, a specific set of tools, and a predictable pattern of behavior. The Fed is the master of the economic tides, and learning to read those tides is an essential skill for long-term capital preservation. The most dramatic historical example of the Federal Reserve consciously and brutally turning up the dial on financial gravity occurred in the late 1970s and early 1980s under the leadership of its then-chairman Paul Volcker. This period serves as the ultimate foundational anecdote for the power of monetary policy. The United States was in the grips of a debilitating economic malaise known as stagflation, a toxic combination of stagnant economic growth and runaway inflation. Inflation had been building for over a decade, and by the late 70s it was spiraling out of control, reaching double-digit percentages. The value of the dollar was eroding, and public confidence in the economy was collapsing. The stock market had gone nowhere for over a decade. It was a period of extreme, crushing financial gravity. Previous Fed chairs had tried to combat inflation with timid, incremental interest rate hikes, but they always lost their nerve when the economy began to slow and unemployment began to rise. They would cut rates again, and inflation would come roaring back even stronger. It was a cycle of failure. In 1979, President Jimmy Carter appointed Paul Volcker, a towering, cigar-chomping, and famously stubborn man, to lead the Fed. Volcker believed that the only way to break the back of inflation was with a form of economic shock therapy. He was determined to restore price stability, no matter the short-term cost. Almost immediately, Volcker and the Fed began to aggressively raise the federal funds rate, their primary policy tool. This is the interest rate at which banks lend to each other overnight, and it serves as the base rate that ripples through the entire economy, affecting everything from mortgages to corporate bonds. The rate hikes were brutal and relentless. The prime lending rate, the rate banks charge their best customers, soared to an unimaginable 21.5% in 1981. Financial gravity was cranked to a level not seen in modern history. The effect on the economy was exactly as Volcker intended. It was devastating. The United States plunged into a deep and painful recession. Unemployment surged past 10%. Farmers, builders, and small business owners were crushed by the impossibly high cost of borrowing. There were protests outside the Fed's headquarters. Volcker received death threats and was given Secret Service protection. He was, for a time, one of the most hated men in America. But he did not flinch. He understood that this short-term pain was the necessary price to pay to purge the poison of inflation from the system. And it worked. By 1983, inflation had collapsed from a peak of nearly 15% down to around 3%. The fever had broken. And in killing inflation, Volcker had done something even more profound. He had reset the entire financial environment. By taking interest rates to such extreme highs and then allowing them to fall as inflation subsided, he had initiated a multi-decade decrease in financial gravity. This act of creative destruction set the stage for the massive, generation-defining bull market that began in 1982 and, with a few interruptions, ran for the rest of the century. Warren Buffett, who lived through and invested through this period, has repeatedly called Paul Volcker a hero. He understood that Volcker's willingness to be unpopular, to inflict pain, to turn up the gravity to its maximum setting, was the very act that created the fertile ground for decades of prosperity and wealth creation that followed. It is the ultimate lesson in the power of the Federal Reserve to shape the economic landscape upon which all investors must operate. The immense power wielded by the Federal Reserve gives rise to a powerful cognitive bias that every investor must contend with: authority bias. This is our natural human tendency to attribute greater accuracy and importance to the opinion of an authority figure. When it comes to the economy, there is no greater authority figure than the chair of the Federal Reserve. We are wired to defer to their judgment, to hang on their every word, and to outsource our own critical thinking to them. The financial markets have become a grand theater of Fed watching, where armies of analysts and traders attempt to parse every sentence, every adjective, in the Fed's public statements for clues about future policy. This creates a dangerous dynamic. The market becomes less focused on the underlying economic data, the fundamentals of inflation and employment, and more focused on guessing the reactions of a small committee of people in Washington, D.C. A single word in a press conference, like describing inflation as transitory, can send markets soaring. The removal of that word months later can send them plummeting. The market's behavior becomes twitchy, neurotic, and short-term oriented. Investors stop thinking for themselves and start trying to read the minds of the Fed governors. They become reactive, not proactive. This authority bias also leads to a kind of collective whiplash. The Fed, in its attempt to guide the economy, often moves in cycles. There are periods where they are dovish, meaning they are focused on stimulating growth, and are willing to tolerate some inflation. In these times, they lower interest rates, decreasing financial gravity. Then there are periods where they become hawkish, focused on fighting inflation, and are willing to tolerate some economic pain. In these times, they raise rates, increasing financial gravity. The average investor, succumbing to authority bias, simply follows these cues blindly. When the Fed is dovish, they feel confident and pile into risky assets. When the Fed turns hawkish, they panic and sell. They are perpetually one step behind, buying high and selling low, because they have ceded their own judgment to the authority of the central bank. A truly successful investor, a practitioner of the CEO mindset, must fight against this bias. They respect the power of the Fed but do not blindly obey its signals. Instead, they seek to understand the Fed's framework, the data that the Fed itself is watching, so they can anticipate the likely direction of policy rather than just reacting to it. They know that the Fed, for all its power, is ultimately a reactive institution, responding to the data as it comes in. By focusing on the data, the source code of Fed policy, you can liberate yourself from the emotional roller coaster of Fed watching and reclaim your intellectual independence. So how does a retail investor or an entrepreneur develop this forward-looking perspective without getting lost in the weeds of complex economic analysis? The key is to build a simple mental model based on the Fed's own stated mission. This is Fed watching for the retail investor, a blueprint for anticipating the tides rather than being swept away by them. Step 1. Understand the dual mandate. The U.S. Congress has given the Federal Reserve two primary goals, known as the dual mandate: to achieve maximum employment and to maintain price stability. That's it. Every decision the Fed makes is an attempt to balance these two, often conflicting, objectives. Price stability generally means keeping inflation at a target rate, which for many years has been around 2%. Maximum employment means keeping the unemployment rate as low as possible without sparking runaway inflation. Step 2. Track the two key data points. Since the Fed's actions are dictated by its mandate, you only need to pay close attention to the two data points that measure its success: the inflation rate and the unemployment rate. The most commonly cited inflation metric is the Consumer Price Index, or CPI. The unemployment rate is reported monthly by the Bureau of Labor Statistics. You don't need to be a professional economist. You just need to know the numbers and, more importantly, the trend. Is inflation rising or falling? Is unemployment rising or falling? These two data streams are the primary inputs into the Fed's decision-making machine. Step 3. Assess the balance of power. Look at the two data points and ask yourself, which one is causing the Fed more anxiety right now? If inflation is running at 7% and unemployment is at a 50-year low of 3.5%, the Fed is not worried about employment. Their entire focus will be on price stability. You can therefore anticipate that they will be in a hawkish mode, raising interest rates and increasing financial gravity to cool down the economy and bring inflation back to their 2% target. Conversely, if inflation is at 1.5% and the unemployment rate has shot up to 8% during a recession, the Fed is not worried about inflation. Their entire focus will be on employment. You can anticipate a dovish stance. They will cut interest rates and decrease financial gravity to stimulate borrowing, spending, and hiring. By using this simple three-step model, you are no longer just reacting to the Fed's announcements. You are thinking alongside them. You can see the storm clouds gathering on the horizon in the form of rising inflation data and begin to adjust your portfolio's duration exposure knots before, knots below the Fed officially announces its first rate hike. This proactive stance is a cornerstone of advanced portfolio strategy. It allows you to protect your capital and even position yourself to take advantage of the predictable market dislocations that occur when the majority of investors, who are still reacting to yesterday's news, are caught by surprise. The antithesis to this proactive approach is the path followed by the "don't fight the Fed" momentum chaser. This investor correctly understands that the Federal Reserve is the most powerful force in the market, but their understanding is shallow. They don't grasp the why behind the Fed's actions. They only see the for a time. Their strategy is to simply align themselves with the prevailing monetary tailwind. When the Fed is cutting rates and flooding the system with liquidity, a dovish, low-gravity regime, this investor goes all in. They leverage up, they buy the most speculative growth stocks, they chase the hottest trends. They feel invincible because the Fed is, quote, on their side. They mistake the Fed's accommodative policy for a permanent state of being, and they mistake the asset price inflation it creates for their own investing skill. They are riding a wave, completely unaware that the tide is controlled by someone else. The problem arises when the underlying economic data begins to shift. Inflation starts to creep up. The labor market tightens. The proactive investor, watching the CPI and unemployment numbers, sees this and begins to dial back their risk. But the don't fight the Fed chaser does nothing. They are waiting for the official signal, the explicit announcement from the Fed chair that the party is over. By the time that announcement comes, the smart money has already repositioned. The market, which is a forward-looking mechanism, has already started to price in the coming rate hikes. This investor is always the last to leave the party. They hear the official announcement, panic, and sell their holdings right as the new high-gravity regime is beginning. Then, after a painful bear market, when the economy is in recession and the Fed finally pivots back to a dovish stance to stimulate growth, this same investor is too scarred and fearful to get back in. They wait until the new bull market is well underway, until the Fed's dovishness is obvious to everyone, and then they pile back in near the top, destined to repeat the cycle. They are always fighting the last war. Their strategy ensures they buy high and sell low, a direct consequence of reacting to the Fed's public statements rather than anticipating their actions based on the economic data that drives those statements. It is a recipe for perpetual underperformance and emotional turmoil. The decisions made in the Eccles Building in Washington, D.C. have a direct, tangible, and often brutal connection to the financial reality of every household and every business in America. The causal chain is clear and undeniable. When the Federal Reserve raises the federal funds rate, it triggers a cascade of effects that ultimately impact the value of your portfolio and the health of the economy. First, borrowing costs for businesses go up. A company that wants to build a new factory or expand its operations must borrow money. A higher federal funds rate translates almost immediately into higher rates on corporate bonds and commercial loans. This increase in interest expense flows directly to the company's income statement, reducing its net income or profit. Lower profits mean lower earnings per share, which, all else being equal, means a lower stock price. Furthermore, a higher cost of capital means fewer new projects will be profitable. A project that looked great with a 4% cost of capital might be a money loser with an 8% cost of capital. So companies will invest less, slowing down the overall pace of economic growth. This is a crucial element of economic analysis that connects the macro to the micro. Second, borrowing costs for consumers go up. The interest rates on mortgages, auto loans, and credit cards are all tethered to the Fed's benchmark rate. When the Fed hikes, the cost of financing a home or a car increases, reducing the purchasing power of the average family. This leads to lower demand for these big-ticket items, hurting the housing and automotive sectors. Higher credit card rates mean less disposable income for other forms of spending, which can cause a broad-based slowdown in consumer demand, the primary engine of the U.S. economy. Third, the entire mechanism of asset allocation shifts. As we've discussed, higher risk-free rates make stocks less attractive relative to bonds. This doesn't just affect retail investors. It affects the largest pools of capital in the world: pension funds, insurance companies, and endowments. These massive institutions are constantly making decisions about how to allocate their trillions of dollars. When they can suddenly get a safe 5% return from government bonds, they will systematically sell stocks and buy bonds until the relative valuations reach a new equilibrium. This institutional selling pressure is a major force that drives bear markets during periods of rising rates. Understanding this direct financial connection demystifies the market. It's not a random, chaotic system. It is a complex but logical machine that responds in predictable ways to changes in its most important input, the cost of money, as determined by the Federal Reserve. Understanding the physics of financial gravity and the institution that controls it is a profound strategic advantage, but knowledge without action is useless. The next crucial step is to translate this understanding into a tangible portfolio strategy, a method for constructing a collection of assets that is not just designed to thrive in one type of environment, but is resilient enough to withstand the inevitable shifts in the gravitational field. This is the art and science of building an all-weather portfolio, a financial arc that ensures your long-term goals are not capsized by the storms of the market cycle. The goal here is not to predict the weather perfectly, but to build a ship that is sturdy enough to sail through any storm. The greatest foundational anecdote for this principle is not a single trade, but the enduring structure of Berkshire Hathaway's balance sheet, particularly as demonstrated during moments of maximum crisis. The 2008 global financial crisis is the perfect case study. In the years leading up to 2008, a period of low interest rates and lax lending standards had created a massive bubble in the U.S. housing market. Financial gravity was artificially low. When that bubble burst, it triggered a cascading failure throughout the global banking system. Lehman Brothers collapsed. AIG, the world's largest insurer, required a government bailout. Credit markets froze solid. Financial gravity was suddenly dialed to an apocalyptic level. Panic was rampant. In this environment of pure terror, nearly every investor and institution was a forced seller. They were facing margin calls, redemption requests, and solvency crises. They needed cash, and they were willing to sell their best assets at fire sale prices to get it. But there was one major exception: Warren Buffett. While the rest of the world was panicking, Buffett was shopping. And the reason he could do this was the structure of Berkshire's balance sheet. He had spent the bubble years patiently accumulating a massive pile of cash and short-term U.S. Treasury bills. He was criticized for it, just as he was in 1999. Analysts complained he was suffering from cash drag, that his conservatism was causing him to miss out on the roaring bull market. But Buffett was not preparing for the weather he had. He was preparing for the weather that was possible. In the chaotic weeks of September and October 2008, when the financial world was on the brink of collapse, Buffett's phone started ringing. The supplicants were the titans of Wall Street, who just months earlier had viewed him as a relic. First came Goldman Sachs. They were a venerable investment bank facing a crisis of confidence. They needed capital, but more than that, they needed the Buffett seal of approval. Buffett invested $5 billion in Goldman Sachs in the form of preferred stock that paid a juicy 10% dividend, and he also received warrants to buy common stock at a very attractive price. Days later, he struck a similar deal with General Electric, another blue-chip giant teetering on the edge. In 2011, he would make a similar crisis-era investment in Bank of America. These were not ordinary investments. They were deals of a lifetime, offered only to him, because he was the only person with both the capital and the reputation to act as a lender of last resort to the system. His famous maxim is to be, quote, fearful when others are greedy, and greedy when others are fearful, but this is only possible if you have the resources to be greedy. His cash hoard was not idle money, it was a call option on panic. It was the ultimate all-weather tool, a reserve of dry powder that allowed him to play offense when everyone else was playing a desperate defense. The fortress balance sheet, overflowing with cash and short-term treasuries, is the physical manifestation of an all-weather philosophy. It is the ultimate expression of preparing for a high-gravity world, not just hoping it never arrives. The psychological principle that makes an all-weather portfolio so powerful is its ability to counteract one of the most destructive forces in investing, loss aversion. Pioneering research by psychologists Daniel Kahneman and Amos Tversky showed that for the human brain, the pain of a loss is roughly twice as powerful as the pleasure of an equivalent gain. Losing $1,000 feels as bad as gaining $2,000 feels good. This asymmetry has profound implications for investor behavior. When a portfolio built for a low-gravity environment, one that is 100% in stocks, for instance, encounters a high-gravity bear market, the losses can be swift and brutal. A 30%, 40%, or 50% drawdown inflicts immense psychological pain. This is not a number on a screen. It is a visceral, gut-wrenching experience. As the losses mount, the pain becomes unbearable, and the investor's rational, long-term thinking is hijacked by the primitive, emotional parts of their brain. This is when the catastrophic mistake happens: panic selling. Overwhelmed by the fear of further losses, the investor sells everything near the bottom of the market, locking in their losses and ensuring they miss the subsequent recovery. An all-weather portfolio is designed in large part to be a psychological management tool. By incorporating assets that are designed to hold their value or even appreciate during high-gravity events, like cash and high-quality bonds, it dampens the overall volatility of the portfolio. The drawdowns are shallower. A 50% market crash might only translate to a 20% or 25% decline in a well-constructed all-weather portfolio. This reduction in volatility doesn't just feel better, it fundamentally changes behavior. The psychological pain is less acute, which makes it far less likely that the investor will panic and abandon their strategy at the worst possible moment. The purpose of the safety portion of the portfolio is not just to provide dry powder for future investment opportunities, as Buffett so brilliantly demonstrated. It is also to provide the psychological fortitude necessary to stick with your plan. It is an emotional anchor in a sea of fear. By deliberately engineering your portfolio to mitigate the terror of deep losses, you are protecting yourself from your own worst enemy, your innate, hardwired aversion to loss. Capital preservation is not just a financial strategy, it is a behavioral one. So how do we apply this principle to our own asset allocation? One of the most effective and intuitive blueprints for an all-weather portfolio is the barbell strategy for shifting gravity. Imagine a barbell, with heavy weights on each end and nothing in the middle. This visual represents the structure of your portfolio. Step 1. Build one end of the barbell, the safety bucket. This side of your portfolio is dedicated to extreme safety and liquidity. Its purpose is capital preservation and opportunity. This bucket should contain assets like cash, money market funds, and short-term U.S. Treasury bills. These assets will not make you rich, but they will not lose significant value in a market crash. In a high-inflation environment, they will lose some purchasing power, but their primary role is as a stabilizer and a source of dry powder. The size of this bucket depends on your personal risk tolerance, but a common starting point might be 10% to 25% of your total portfolio. Step 2. Build the other end of the barbell, the growth bucket. This side is where you take calculated risks in pursuit of high long-term returns. This bucket should be filled with a diversified portfolio of high-quality equities, the kind of businesses you would want to own for a decade or more. The selection of these equities should be guided by all the principles we have discussed: a keen awareness of their valuation, their balance sheet strength, and their sensitivity to changes in financial gravity, their duration. Notice what is missing from this strategy: the middle. The barbell approach avoids assets that have a muddled risk-reward profile, like many complex, high-fee alternative investments or long-term corporate bonds that offer neither the absolute safety of treasuries nor the high growth potential of equities. It is a strategy of extremes: extreme safety on one end and high conviction, concentrated risk on the other. Step 3. Define your rebalancing rule. This is the most critical step, as it operationalizes the strategy and forces you to be counter-cyclical. The rule connects the barbell to the prevailing financial gravity. A simple rule might be: at the end of every year, I will rebalance my portfolio back to its target allocation, e.g., 75% growth, 25% safety. In a bull market, low gravity, your growth bucket will have grown disproportionately. Your rebalancing action will be to sell some of your winning stocks and move the profits into your safety bucket. This forces you to take profits and build up your dry powder when things are good. In a bear market, high gravity, your growth bucket will have shrunk. Your rebalancing action will be to deploy capital from your safety bucket to buy stocks at depressed prices. This forces you to be, quote, greedy when others are fearful. This disciplined, rules-based rebalancing transforms the barbell from a static collection of assets into a dynamic, adaptive system for navigating the market cycles. The antithesis to the resilient barbell strategy is the approach taken by the quote, 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 100% of the time investor. This individual operates under a set of seemingly logical but ultimately fragile beliefs. Their primary mantra is, "Cash is trash," a phrase that feels profoundly true during a long bull market. They view any allocation to cash or bonds as a drag on performance, a cowardly refusal to embrace the superior long-term returns of the stock market. They are fully invested, all the time, often in an aggressive mix of equities that may be heavily tilted towards long-duration growth stocks. In a low-gravity world, this strategy appears brilliant. This investor's portfolio outperforms the more conservative all-weather approach year after year. They feel validated in their aggression. They may even mock the barbell strategist for their timidness. But their portfolio has a fatal flaw. It has no shock absorbers. It is a high-performance race car with no brakes and no airbags, designed exclusively for a straight, dry track on a sunny day. When financial gravity inevitably increases and a severe bear market hits, the 100% equities investor is completely exposed. Their portfolio experiences the full, terrifying force of the market's decline. A 50% drop in the S&P 500 is a 50% drop in their life savings. This is where theory meets brutal reality. They may have told themselves they were a long-term investor who could stomach the volatility. But as we know from the principle of loss aversion, the psychological pain of such a rapid and deep loss is often too much to bear. Worse, this investor has no optionality. Because they have no safety bucket, no dry powder, they are unable to take advantage of the generational buying opportunities that appear during a crisis. Instead of being a buyer, they may become a forced seller. A job loss, a medical emergency, or a margin call can force them to liquidate their high-quality stocks at the worst possible moment, permanently converting a temporary paper loss into a devastating real one. Their strategy has no defense, no flexibility, and no room for error. It is a brittle strategy, and in the unpredictable world of financial markets, what is brittle is destined to break. The direct financial connection between an all-weather strategy and long-term wealth creation can be demonstrated with the simple, powerful math of compounding. The superiority of a resilient portfolio is not found in its performance during bull markets, but in its defense during bear markets. This is because of the brutal asymmetry of losses. Consider two investors, each starting with $100,000. Investor A is the 100% equities investor. Investor B is the barbell strategist, with a 75% allocation to equities and a 25% allocation to cash. In year one, there is a powerful bull market, and equities return 30%. Investor A's portfolio grows to $130,000. Investor B's portfolio, with its cash drag, only grows to $122,500, a 22.5% return. Investor A feels like a genius. In year two, a vicious bear market strikes and equities fall by 40%. Investor A's portfolio, which started the year at $130,000, plummets to just $78,000. They have now lost 22% of their original capital. Investor B's portfolio started the year at $122,500. Their 75% equity portion loses 40%, but their 25% cash portion loses nothing. Their total portfolio value falls to $87,375. They have lost about 12.6% of their original capital, a painful loss but significantly less devastating than Investor A's. Now, here is the crucial part. To get back to their starting point of $100,000, Investor A needs to make a gain of 28.2% from their current low. Investor B only needs a gain of 14.4%. The smaller drawdown means the climb back is far less steep. Over many market cycles, this effect is magnified enormously. The investor who avoids the catastrophic declines will almost always end up with a higher compounded annual growth rate, CAGR, the ultimate measure of long-term investment success. This is the financial magic of capital preservation. The first rule of compounding is to never have to start over. The all-weather portfolio, with its focus on mitigating drawdowns, is a financial machine designed to honor that rule above all others. We have now explored financial gravity from the perspective of the outside investor, the person allocating capital in the public markets. But to complete our understanding, we must step inside the company itself. We must adopt the CEO mindset and ask, how does a world-class business leader and operator use this same principle to make decisions about capital allocation? The best CEOs are not just brilliant managers of people and products, they are master capital allocators. And their decisions about when to take on debt, when to acquire other companies, and when to return cash to shareholders are all profoundly influenced by their understanding of the prevailing level of financial gravity. There is perhaps no better embodiment of this CEO mindset than Tom Murphy, the legendary leader of Capital Cities/ABC. Warren Buffett, who is not prone to hyperbole, has called Murphy the best business manager I've ever met. Murphy's entire career was a masterclass in rational, disciplined capital allocation that was perfectly attuned to the economic environment. His most famous and audacious move was the 1985 acquisition of ABC, the major television network. At the time, Capital Cities was a successful but much smaller media company. Acquiring ABC was a case of a minnow swallowing a whale. The deal was valued at $3.5 billion, an enormous sum at the time. What made this possible was Murphy's shrewd understanding of the financial environment. Interest rates had peaked a few years earlier under Paul Volcker and were now in a steady decline. The cost of borrowing was becoming cheaper. Murphy recognized this low-gravity environment as an opportunity. He was able to use debt strategically and, with a crucial investment from Buffett's Berkshire Hathaway, finance the massive acquisition. But acquiring the asset was only half the battle. Many CEOs can use cheap debt to buy things. Murphy's genius was in what he did next. He and his partner Dan Burke were famously frugal and operationally ruthless. They immediately set about cutting the notorious bloat and corporate excess at ABC. Their focus was singular: generate as much free cash flow as possible. And what did they do with that cash flow? They used it to aggressively pay down the debt they had taken on to do the deal. Murphy understood that a low-gravity environment that allows you to borrow cheaply might not last forever. He was obsessed with de-risking the balance sheet. He was, in effect, preparing the company to withstand a future return to a high-gravity world. This discipline is incredibly rare. For most CEOs, cheap debt is an excuse for perpetual expansion. For Murphy, it was a temporary tool to be used for a specific purpose and then discarded as quickly as possible. His decisions were always framed by a core question: what is our cost of capital, and can we generate a return that is safely above it? This rational, environment-aware approach to executive decision-making is what allowed him to build one of the most successful media empires of the 20th century. The psychological flaw that Murphy so brilliantly avoided is one that ensnares a huge number of corporate leaders, especially during bull markets: the overconfidence effect. This is our tendency to overestimate our own abilities and knowledge. In a low-gravity environment, when money is cheap and the economy is strong, almost every business looks good. A rising tide, as they say, lifts all boats. A CEO presiding over a company whose stock is soaring can easily fall into the trap of believing that this success is due entirely to their own unique genius. They start to believe their own press clippings. This overconfidence, fueled by a benevolent economic environment, often leads to disastrous, value-destroying decisions. The most common is the ego-driven top-of-the-market acquisition. The overconfident CEO sees their high-flying stock price not as a reflection of a frothy market, but as a powerful currency. They decide to use this currency to buy a competitor, often paying a huge premium. The deal is celebrated on the front page of the Wall Street Journal. The CEO is lauded as a visionary empire builder. But the acquisition was driven by hubris, not by a rational calculation of its potential return on investment. The CEO has confused the tailwind of low interest rates with their own managerial skill. When financial gravity inevitably increases, these sins are exposed. The cheap debt used to finance the deal becomes a heavy anchor. The promised synergies from the merger fail to materialize. The massive price paid for the acquisition becomes an albatross, leading to huge goodwill write-downs on the balance sheet. The visionary empire builder is revealed as just another executive who bought high. Tom Murphy's genius was his humility. He never let the buoyant mood of the market cloud his rational judgment. He operated with a deep understanding that the economic environment was a powerful force that could be an ally or an enemy. His humility and his focus on the numbers insulated him from the overconfidence that has destroyed so many of his peers. How can entrepreneurs and business leaders cultivate this same discipline? The answer lies in establishing a rational, unwavering mental model for all major capital decisions. Let's call it the hurdle rate reality check. This blueprint forces an objective, mathematical rigor into what can often be emotional, empire-building decisions. Step 1. Calculate your WACC. A company's hurdle rate should be based on its weighted average cost of capital, or WACC. This sounds complex, but it's a simple concept. It is the blended average cost of the money the company uses, both the debt it owes to lenders and the equity it owes to its owners in the form of expected returns. You don't need to calculate it to 5 decimal places. You just need to understand the concept. Your company has a cost of capital, a price it pays for the fuel that runs its engine. Step 2. Tie your WACC to reality. The most important thing to understand is that your WACC is not a static number. It is directly tethered to the prevailing financial gravity. The two main components of WACC are the cost of debt and the cost of equity. The cost of debt is obviously tied to interest rates. As the Fed raises rates, your cost to borrow goes up. The cost of equity is also tied to interest rates, because as the risk-free rate rises, the return that your shareholders demand for taking the risk of owning your stock also rises. Therefore, as the Fed raises interest rates, your company's WACC, its fundamental cost of capital, goes up. Step 3. Make the hurdle rate a hard and fast rule. With an understanding of your current WACC, you can now implement the rule. No new project, no new hire, no new acquisition gets approved unless its expected return on investment is significantly above your current WACC. This becomes your hurdle rate. If your WACC is 9%, you might set your internal hurdle rate at 15%. This creates a margin of safety. The crucial discipline is that this hurdle rate must be dynamic. In a low-gravity world where your WACC is only 5%, your hurdle rate might be 10%. Many projects will clear that bar. In a high-gravity world where your WACC is 12%, your hurdle rate must rise to 18% or more. Far fewer projects will be approved. This framework forces the business to adapt its investment appetite to the reality of the economic environment. It replaces ego and overconfidence with a rational, objective filter, ensuring that the company only deploys its precious capital into ventures that promise a truly superior return. The antithesis of the disciplined capital allocator is the growth-at-any-cost CEO. This type of leader becomes a media darling during the low-gravity, speculative phases of the market cycle. Their entire focus is on growing top-line revenue, often with a complete disregard for profitability or return on invested capital. Their language is one of blitzscaling, capturing market share, and disrupting industries. In the zero-interest rate environment that followed the 2008 crisis and was supercharged during the pandemic, this model of business became the dominant paradigm, especially in the tech sector. With capital effectively free, investors were willing to fund years, even decades of losses in pursuit of eventual market dominance. The growth-at-any-cost CEO was happy to oblige. They raised massive rounds of venture capital, issued billions in cheap debt, and used their inflated stock to acquire competitors. Their income statements showed exploding revenues and equally exploding losses. Their balance sheets swelled with debt and goodwill from overpriced acquisitions. For a time, this looks like brilliant strategy. The stock price soars, driven by the narrative of growth. The CEO is celebrated as a bold visionary. But the entire business model is predicated on the assumption of permanently free money, a world without financial gravity. When the Federal Reserve was forced to raise interest rates aggressively in 2022 to combat inflation, this model shattered. Suddenly, the cost of capital was no longer zero. The debt on the balance sheet began to accrue real, painful interest expenses. The ability to raise new rounds of funding from investors dried up, as those investors now had attractive, risk-free alternatives. The mantra from the market changed overnight from "we want growth" to "we want a path to profitability." The growth-at-any-cost CEOs were caught completely flat-footed. They were forced to slam the brakes on their spending, lay off thousands of employees, and shut down their speculative moonshot projects. Many of their companies saw their stock prices collapse by 90% or more. Some did not survive. Their failure was a direct result of building a business strategy that was fundamentally incompatible with the laws of financial physics. They were sprinting, full speed, towards a cliff, completely unaware that the ground beneath their feet was about to give way. The ultimate financial metric that connects a CEO's decisions to the force of financial gravity is return on invested capital, or ROIC. This is a measure of how efficiently a company is using its capital, both debt and equity, to generate profits. A high ROIC is the hallmark of a great business run by a great manager. But the quality of that ROIC can only be judged when it is compared to the company's cost of capital, its WACC. Imagine a business that consistently generates an 8% ROIC. Is this a good business? The answer depends entirely on the level of financial gravity. In a low-gravity environment, where the company's WACC is only 4%, this is a fantastic business. For every dollar it invests, it is creating 4 cents of excess value. It is a value creation machine. The CEO should be encouraged to reinvest every penny of profit back into the business to grow as fast as possible. Now let's transport that exact same company with the exact same 8% ROIC into a high-gravity world where its WACC has risen to 10%. Now, for every dollar the company invests, it is destroying 2 cents of value. The operations of the business have not changed at all, but it has been transformed from a good business into a bad one by the external economic environment. In this scenario, the CEO's mandate should be the opposite. They should stop reinvesting in the business and instead return as much capital as possible to shareholders through dividends or stock buybacks, because the shareholders can likely earn a better return elsewhere. This is the pinnacle of the CEO mindset, understanding that your job is not just to run the business, but to run the business in a way that intelligently responds to the gravitational field of the day. It is the final, crucial link in the chain that connects a decision made by the Federal Reserve to the fundamental strategy and ultimate value of a business enterprise. And so, we arrive at the end of this particular journey. You have just been given a powerful lens, a new way of seeing the financial world not as a chaotic casino, but as a system governed by a clear and predictable force. You now understand that interest rates are the financial gravity that tethers all asset prices to reality. You have seen how this force was used by Warren Buffett to sidestep the dot-com crash. how it brutally punishes the speculative, long-duration growth stocks that capture the public's imagination, and how it is ultimately controlled by the Federal Reserve. You have been given the blueprint for an all-weather portfolio and a glimpse into the CEO mindset that uses this principle to build enduring empires. This knowledge, this mental model, is a permanent upgrade to your financial operating system. It is a tool that can protect you from the most common and costly mistakes that plague the average investor. But it is crucial to understand that this is only one piece of the puzzle. Buffett's entire system of thought is not a single pillar, but a magnificent, interconnected latticework of mental models. Understanding financial gravity gives you the context, the understanding of the environment in which all businesses operate. But it does not, by itself, tell you which specific business to buy. It is like having a flawless weather forecast, but still needing a map to navigate the terrain. The force of gravity is universal, but the sturdiest, most well-built structures can withstand it far better than the flimsy ones. The video that is about to appear on your screen is the next part of that map. It is the link that connects the macro environment to the micro-level decision of which company to own. It addresses the next logical question. Within a given gravitational field, what specific characteristics allow some companies to thrive and compound wealth for decades, while others crumble under the competitive pressure? It is the missing link that connects the when of investing with the what. The choice to click is not about watching another video. It is a conscious decision to continue your ascent, to add another indispensable tool to your mental arsenal. The casual observer is content with a single insight. The true student, the future master of their own financial destiny, understands that the journey is never complete. They are compelled to find the next piece of the map. The choice is yours. Complete the connection. Continue the journey.